Good afternoon, everybody. Welcome you all to the MK Confluence. India has evolved at many levels in the previous decade, and one noticeable change is financial inclusion. With regard to the same, we now move our focus to the microfinance sector, a space that sits at the intersection of financial inclusion, rural growth, and social impact. We have with us two veterans and leaders who bring in deep perspective on where the sector is headed. Mr. Alok Misra, CEO and Director of the Microfinance Institutions Network, has been a strong voice in shaping policy and best practices for the industry. He has nearly 28 years of professional experience in policy design and analysis, implementation and evaluation across 22 countries of Asia, Africa, and the Pacific. Joining him is Mr. Ganesh Narayanan, Managing Director and CEO of Credit Access Grameen, one of the India's largest and most successful microfinance institutions. He has a rich experience of over 26 years across various facets in the BFSI industry and has extensively worked across rural and agri, banking and MFI space. Together, Mr. Misra and Mr. Narayan will unpack the opportunities, challenges and evolving dynamics of the sector. The topic for today's session is Building Resilient and Future-Ready MFI Sector. Let's welcome them both to the stage for this important conversation with our lead banking analyst, Mr. Anand Dama. Over to you, Anand.
Thank you and good afternoon to everyone. I know this is a post-lunch session, but we will try and keep it very lively. The sector is very interesting. Just before that we were discussing whether the sector is into some kind of a cyclical stress or a structural stress. I'm sure a lot of insights that we will actually get from Alok sir and Ganesh. But the main topic that we have for this session is how to build a resilient and a future-ready MFI sector. Because we have seen multiple asset quality disruptions which have actually come in the sector that has hurt the growth. After FY17, this is first year where we have actually seen a degrowth in the microfinance sector. And the cycles have actually become shorter and shorter. Every 2 years we have seen some kind of disruptions. So I think the time has come when I think the industry as a whole and the players together need to think about how to build a resilient and a future-ready MFI sector, and so the companies as such. So what I'll do is basically I'll start with the fire chat session, and then we will open up the floor for questions from audience. So my first question is to Alok sir and Ganesh sir both. So after under crisis, we have seen multiple disruptions which have actually come into the sector. Do you think that the MFIs need to reorient their growth playbook to avoid frequent asset quality shocks?
So thanks, Anand. Thanks for having me here again. And on the strategy side, on growth side, I think there is nothing wrong being done. So I will explain it. You can cross-question me on that. But the thing is, if you refer to AP crisis. After that, if I look back, their 2016 problem was there. That is demonetization. Not by the sector. Then 2020 to 22 COVID, not by the sector, external problem. And 24 onwards, the phase which we are in that also, if I tell you there are 4 factors, I would not completely say that we are holier than thou, and there was nothing which was, everything was very clean from our side. There were issues which we have tried to curtail, but there were other issues also. For example, it all started, if you look at the chronology, it all started April, May, June in extreme heat wave last year in 24. Then elections, a little bit of disruption. Then 6-7 months we fought over, and even now we are fighting them, is the Karja Mukti and other non-state actors trying to disrupt credit discipline. Even Reserve Bank, when I requested the governor, they had to issue a press release saying, don't fall in their system. And by that time, we were trying to get a handle of it by November and December. In January, the Karnataka thing started. We tried to curtail it. Hopefully, we are out of it. And now then again. So these 4-5 things which I listed are completely out of the sector. This is the dynamics in which the sector operates, and it is not in our control. But yes, there are other issues in the sector. We always, as an SRO, we always say that the growth has to be tempered, growth has to be realistic. There should not be even pockets of over leveraging, and behavior with the client should be fine. We should not get reports of it. So all those things are there, which we later on I can talk to you about that. But overall, I don't see a fundamental. There are many challenges which are emerging, like group discipline. I hope it will be in your question. Digital adoption, its impact, and other lenders getting into this sector. There are various challenges which we are thinking about how to deal with it. But I don't see any fundamental change as such in those times, except being cautious and temperate, not to get overboard. I always tell the sector leaders that it is no longer a game where you get money and you pump. You have to look at the broader context in which you are operating and accordingly target it. Earlier, 7 years back, it used to be you get the money, pass it down. It is no longer that game. You have to hold, you have to see the conditions, macroeconomic conditions, accordingly progress. That's the only fundamental change.
Thank you. From my side, I think I tend to second with Alok sir's views, but I also feel very strongly that the underlying customer segment, while we are seeing some changes, but we still can't question their genuinity, right? So majority of the customers are still paying us on a daily basis. Our current collection rates are demonstration of that. We did have a certain amount of tough period. In fact, I would say last year was one of the toughest periods for us with respect to recovery. But the nature of the customer is not changing. Probably the occupation trends are changing. Employment of women are changing. Adoption of digitization is changing. From that perspective, yes, the model may have to be understood a little better to how to deliver going forward. What are the changes that we need to bring in, etc. A few things that come to my mind with your question is clearly, I think the potential is still very strong. Financial inclusion seems to be a very closely tracked topic for the government as well as the regulator. And in many forums, we've been acknowledged for the role that we've played in financial inclusion. I think it's a question of how industry can work to handle these challenges. That again, with the evolution of the SROs being the backbone for the industry and everybody coming together, whatever the crisis is today, at least we are able to voice it together one way and march together uniformly. We would, I would tend to believe that what we are seeing now is temporary, and as long as people focus on fundamentals of doing microfinance, especially exhibit a little bit of patience before giving money, because I think the core of fundamentals is in process. Otherwise, it's one of the simplest forms of lending. You start lending small, create credit discipline, understand the customer, and you increase over a period of time. But I think if you are able to reinforce your processes, keep your checks and balances stronger. And today, with respect to digitization, you also have better visibility, you have better connect with customer, you can establish transparency. A lot of good is also happening. If we kind of converge it to the advantage of the industry, industry should continue growing, not necessarily at the older pace, because you have guardrails now. You are seeing stressful pockets, so people are tweaking their policy on various bases. In our example, we tweak our policy today at district level. Right? We are working on seeing if there are any other parameters that we identify. Probably age is one factor that's coming out. We are seeing customer average balances is another aspect that could come out. So you could pick up data points over a period of time. And since you have a very a large stress book now, so we are also able to analyze it better. You have visibility to customer household debt today. A lot of things can shape the future of this industry. I think we will come out of this and we should start growing moderately over the next few quarters.
So, one thing that's what happens is that you tell to the large players, obviously they tend to abide, they slow down the growth, they understand the impacts, but the tail in the microfinance is very large, very thick, and at times basically that hits the entire industry, the head also, in terms of the larger players. That's what I think has happened in terms of over leveraging, where the larger players did had their discipline altogether, but then there were small players who came and then they basically did multiple lending. Anything that as an SRO, as a regulator, basically that you would try and do basically to curtail this tail from overgrowing, and basically they hit the sector and the sector suffers.
Well, number one, that if we look at the sector composition in NBFC MFIs, I am not talking about banks and SFBs currently, who are also our members. If I look at top 10 players now, and they are controlling 90% of market share. So, and if I go to 15, it will get into, I think, 93 or 94. So, 6% dragging 94%, I don't agree to it, number one. Second, even if 6% also should behave. So like we have total, I think today, as of today, we speak 52 NBFC MFI members. Out of that, so 15 you take out, which are 94%, so remaining is around 35. Rules are applicable to all. And when we say the rules, these are not paper rules. Every quarter, you take out the quarterly adherence report on the disbursement done during that quarter, and we see the adherence to the 3-4 covenants, which are verifiable from the credit information company. Individual companies' results come in. Wherever we see violations which are there, we take it up with them. And if the response is satisfactory due to some technical error or due to the difference between two bureaus, it's fine. If it is a question of systems, it is a question of intent, then enforcement action is there. The enforcement directive and the enforcement escalatory ladder, that is all available in public website and reported to Reserve Bank of India. So you should not worry about 6%.
So not only 6%, even among the larger players, there is a tail, right? In the
Acha, in
NBFC
15
MFIs, even
in-
in the banks, the SFBs, there are players basically who tend to become aggressive because they want to grow into that sector. And then, we have this multiple lending situation, and that hurts the larger sector altogether. So I think some kind of, basically, I think some directive basically which has to go that, okay, fine, once the cycle will turn positive is when I think you will have to temper your growth expectations, because there are other segments where you can actually grow rather than not,
Now,
hitting the sector.
Now let me give you data from the other side of it. Now that you broadened the debate from tail to NBFCs and SFBs and banks and all that, no? See, if I analyze the sector, and tonight, I think today or tomorrow, the June report of CRIF, CIC will come out. So you have that data. So I have seen that report in the draft stage, so I can share the data. Clients having our guardrails of the SRO MFIN, which is monitored, says that if for a microfinance lender, there should not be more than 3 microfinance lenders, irrespective of regulated entity, bank, SFB, NBFC, NBFC. Now, only 4.1% borrowers are left who still have more than 3 lenders. And that are legacy. So it is gradually coming down. Earlier it was, when we introduced the guardrail, it was I think around 8. It has come down to 4.1. By December, it will come down to 1.5 or 1%. So that should be enough. And then in terms of growth, we also have a cap that any microfinance loan or any microfinance client, irrespective of whatever be the loan income, should not have loans more than 2 lakh rupees. Not only microfinance, but also including unsecured retail loans, because there is 10% clients who also take unsecured retail loans, personal loans and all that. So we have factored that into it. So the guardrails are perfect. There is no full other better solution to it. And I'm happy that the industry, though, like even banks, have adopted it. And even top players like Ganesh from Credit Access, top NBFC, MFI, banks, SFBs, all have fallen in line. And it is not only to them, but every quarter it is also reported to Reserve Bank.
So related question is that whether the MFIN guardrails that we have seen for JLG loans are like permanent in nature or could be eased once the leverage levels actually come down in the industry.
Well, now this is a monetary policy type of question, whether the stance will remain accommodative or neutral or will turn negative. So we will watch the situation. Suppose after 1.5 years, the Reserve Bank of India comes out that the household income limit, which people will demand, is raised from 3 lakh to 4 lakh. There will have to be some fine tuning of the guardrails. So as the situation evolves, as the data speaks on the ground, we will take decision.
Great, good to hear that. The another question is that obviously we have had this MFIN guardrails on JLG. The individual lending segment is also picking up a lot now. In the garb of individual lending, there is some kind of evergreening. That's what industry talks about that is happening in terms of evergreening and all. Maybe not now, but maybe in the foreseeable future, do you see that some kind of guardrails also need to come in case of the individual loan segments?
See, yesterday in our press conference, I addressed this question. Number one, see, microfinance loans, once you have defined, our guardrails are methodology agnostic. You are individual, you are JLG, you are SHG, you are JLG individual, all sorts of variants you can adopt in the field. As long as you are classifying that loan as microfinance, we are methodology agnostic. That addresses your question?
But is that the right way to do it? Because I think individual loans basically could be on a higher side, right? Whereas JLG loans possibly would be capped at 2 lakhs.
Okay. If it is a higher loan, then why are you giving it to a household with 3 lakh annual income? Then you give it in normal course. Then you are either suppressing the household income and you are trying to fit it into. If you are force fitting it into microfinance, or if it is actual microfinance, you are classifying it as individual, then you should be microfinance. Why I should be bothered about the methodology you adopt? I am bothered about the classification, the thematic focus. If the agriculture loan comes whether in form of KCC or term loan, I am agnostic to it. I am bothered about the type. And the type remains microfinance, and there are 3 criteria. The household income should be less than 3 lakh, it should be collateral free, that's it. Then you are under us.
Ganesh, you have any thing to share on this?
Yeah. So again, the point is for most of us, the individual loans is towards graduating customers. As long as you're selective, as long as you're picking customers who've moved up the cycle from microfinance into a higher income bracket, I think that book will do well, right? So if you're careful, if you are investing a little more time and energy towards cash flow assessment, because you're no more assessing 20, 30 people together. You're talking about one person, you're graduating them from a 50,000 loan to a loan which is greater than 1 lakh or 2 lakh. Genuinely, I think people will put more effort. And for the other part, like Alokji said, if you're basically giving even individual loan to a 3 lakh and below income customer, as long as the guardrails are there, it will protect it, right? So that's how I feel about it. So I don't see the industry as such tending to move to individual loans to do away with guardrails, right? It's only defeating our own purpose.
Sure, that's very helpful. The another question, particularly to you, Ganesh, is that at Credit Access, now that you have become MD and CEO as well, so how do you plan to build the portfolio resiliency going forward? What are the measures taken to strengthen customer sourcing, engagement, portfolio monitoring, and collections, particularly in view of recent asset quality issues that we have seen? Do you believe that maybe CredAC should build some kind of counter-cyclical provisioning buffers, given frequent asset quality shocks that the industry has seen, and so has the CredAC? And then maybe, sir, you can also share your views, particularly on this question.
Right. I think with respect to credit access as such, we have evolved a model over a period of time which has worked well consistently in both good and bad times. At bad times, we do get impacted, but we are better protected. And today, for example, we have one of the highest provisioning rates in the industry, right? We provide quite strongly. We recognize risk very early, and you know, the only thing in my view that could change going forward is probably adopt technology better. We can look at solutions which are helping us underwrite better, probably check your customer validity better. So some of these we've already adopted. We've also taken the journey of digitization of our customers. Today we do around 16% of our collections through a digital channel. So that's something that is very interesting to see how customers will move, right? So there could be a lot of demand from the younger generation who are coming into microfinance. So today, most of our customer profile is 40 plus, right? And as you get newer borrowers, they are coming with more digital options. So we'll have to build a model which can handle two direction. In my view, microfinance per se, you can sharpen how you're underwriting. Your key focus on process, in my view, strong belief, whatever you need to do before giving money. So you need to keep on strengthening that. And you can adopt technology to underwrite, probably assess cash flow better, look at the livelihood standards of this customer, to correlate whether what is getting assessed as income is better. It's a long journey, but very interesting things happening. And I think it will only get better and sharper as we move ahead. But the core is not changing in the company. We have a very strong team, very culturally process-driven, focused team. And we have a midterm vision of 2028, and we're working towards that, right? In that process, our current focus is to see how we can sharpen each of these aspects that we do. Like I said, it could involve a lot of digitization. It could involve things like over the last 2 years, we've strengthened a BRE engine. So we are able to, kind of modify your policy much finer depending on various aspects, etc. So I think from tech side, there will be a very strong spend. There could be a lot of AI kind of interventions. We've automated most of our processes. We've done a lot of robotic processes when it comes to mundane tasks. So a lot of tech side uplift is going to be there. And there is going to be a focus on fundamentals. And you know that we've also taken the journey of diversification to a certain extent. So basically follow the customer strategy. So as we move forward, I believe the length of association of the customer and microfinance probably will get shorter because they are aspirationally wanting to become a better profile customer. So whoever is getting better cash flow, probably they'll not want to continue in microfinance because alternative models are evolving. So those are things I think we will focus on, and we should move forward strongly as we move ahead.
And any, reply to basically the counter-cyclical provision buffer that you would ever want to build?
So that's something that I already said. In our nature of provisioning, if you see, we provide higher than any metric, for example, right? So say stage 2, we provide roughly around 55%. Stage 3, we provide 65%. We recognize stage 2 at 15 days. We recognize stage 3 at 60 days. We write off at 270 days. During stress periods, we do accelerated write-off. So you are creating a balance sheet which is got buffers inbuilt in it. And as we see stress, because of the strength of the balance sheet, you're recognizing and cleaning it faster to give you a stable period as soon as possible. So at this point of time, I don't see there is additional buffer that you can build. Also, as per Ind AS, you have to take the ECL model. ECL model has to be backed by data of a longer period of time. And kind of management overlays or additional buffers at this point of time is not doable or may not be warranted, is what I feel.
So your perspective on maybe Credag is much more conservative, but then there are other players who need to build this kind of management overlay. Like if you look at the larger banks like ICICI, HDFC Bank, who have been aggressive in terms of retail lending, what they did basically they became aggressive, but then on the other hand they tried to be conservative on the provisioning policy as such. So they also have a specific PCRs that they keep higher and then still build some kind of counter-cyclical provisions whenever they have one-off gains as such.
first of all, operational side he has talked about. On the your additional buffer thing, I would fully agree in case of top NBFC MFIs to what he said, is that under ECL India AS, when they do provisioning as per ECL, that is already accelerated. And I don't see, because if you look at anybody's PCR would be, even the lowest in top players would be 75%. Some would be as high as 90. Some say that we are NNPA 0% company. So GNPA might be there, but we are fully provided for. So I don't think any buffer is required. The other difference which you have to notice is that in case difference between banking side and the NBFC side is that in case of banks, the capital adequacy is how much? Prescribed by RBI, 8%. Some good banks would have 12%.
9 to 10%. Some have
people
10,
have 10,
some have
11.
15.
Here, all the top 10 players would have 25%, 20% upwards. So that's additional level of comfort. Now, so in NBFCs, I think counter-cyclical buffer is self-defeating. It seems like, it will seem like that then better you don't do any lending. If 100% you are provided for, your capital adequacy is around 20 plus, then what is the need for counter-cyclical buffer? And even under Basel, at 9% capital adequacy framework, tier 1 and tier 2 put together, 10% in Basel 3, the new thinking, the counter-cyclical buffer is how much? 1 to 1.5%? So that more than that is covered. And in case of banks, when you said because they are under IREC norms, so their provisioning can be lower because that is governed by RBI, not by ECL. But there also RBI has now circulated the draft paper. I think they are soon going towards that because banks also have to move towards India. So that will be taken care of. And their larger balance sheet, they can take care of. So I don't think for this 2% of India's financial sector, you need any counter-cyclical buffer.
So in fact, what happened is that why do we need this is again because, I mean, there is one entity which went down almost, had to raise capital, you know. There was a capital call which came in, management change happened. So that may not be the case with the larger banks because they have stronger balance sheets. But in case of NBFCs and NBFC microfinance, those things have happened. So do they have higher capital buffer? But then when these kind of events happen, these shocks, I would say, the buffer goes up, goes down basically. And that's where I think, particularly for the these kind of entities, is when I think some kind of prescription, some kind of recommendations need to come.
I get your point. But even in, let us limit to that specific case also. Even in the worst of scenario, when 800 crore or roughly around that loss had to be booked in 1 quarter, I think if I'm right on that figure, even then the capital adequacy fell to how much? 14, 15%? So it was still above the RBI threshold. Huh? It was there about 15 or 15.5. It's still higher 5 percentage point than best capitalized banks. But, and what the capital the promoter put in later on, that is more of a confidence capital rather than a regulatory requirement or a prudence requirement. It's a confidence capital that despite all this, the promoter is in the business for the longer term. So, you get my point?
Sure, sir. So basically, we're not building any provision buffers, and we're not. So I think when we have a next shock, maybe again we will have these kind of incidents which will happen.
The point is, he's saying it's already inbuilt, both by way of capital as well as ECL. There could be some exceptions, but as long as it is supported by strong promoters, they will always step in, right? Even that's what he's trying to say.
Sure. The next question is to Ganesh again. You RBI has recently lowered the minimum share of qualifying assets. You touched upon that. There's a diversification that you're looking at. So what are the new segments that you would look at now that it was 85, then now it's 60? So what are the opportunities that you see to develop those portfolios? And again, I think those portfolios will have its own challenges. Different risk management structure, different people skill set is what you got to acquire. Tech obviously is a hygiene factor, you got to have it. So what are we doing on that front? And sir, then from your side, you speak to so many MFIs, what's the plan over there? What is that you would suggest? Because they have, microfinance being an unsecured segment, so to say, what is your recommendation for those people?
Okay. Thank you for that question. So if you look at our journey so far, right? So we've always been trying to see what this customer segment needs and what needs to be offered, and accordingly our product ranges have been that way, right? So we're not a single product MFI. We have a life cycle product we have tailor-made products for each of their needs. It could start as small as a small need as a festival where a few thousand rupees they may need. So the whole concept of how we think and we've built this model is to ensure that customer, actually we are able to meet the customer's genuine needs given that we are meeting them on a weekly basis and avoid them going to the private lenders, right? So because the more they go to the private lenders, then you become lower priority and probably it gets them into a debt trap. So we've created products after a well thought process in such a way that if they need a small loan, if they want a 5,000 rupee, they come to me, not necessarily go and borrow a 50,000 rupee loan or a 25,000 rupee loan. So address specific needs of them at specific time frames in specific stages of their life cycle. Now, when we took this journey, while we have a strong customer retention, we also saw around 15% of our customers are dropping out every year. And when we look at them deeper, maybe some of them we don't want to lend or they don't want to borrow, but some of them are moving up the ladder. And we saw them going into unsecured business loans or secured business loans because, like I said earlier, certain profile of these customers will move up, right? So not everybody will move up, but in our estimate, around 15-20% of our customer base has a potential to move up over a period of time. And that segment, if we are able to hold them for a longer period of time, because basically you brought them into a formal lending system with no credit cycle, no credit history. You create a credit history and kind of give them to somebody else who's charging them higher than a microfinance loan. So that was the first reason why we ventured into it. We've already done 3 years of this business now, and we have around 7% of our book which is non-microfinance. So our thought process, customer going forward will come into microfinance. The ones which are weaker or have very minimal needs will continue to be in microfinance. The more entrepreneurial ones will jump up. So they'll spend a few years in microfinance and they'll start moving to individual loans. And that segment, before they go to a bank, there is a journey that they can continue with us. So that's how we started diversification. And because the regulation had certain caps earlier, and then it became 25, that created a little more interest. So over the last few years, we've been able to create close to around 2,100 crores of non-microfinance book. And this has behaved really well. And again, the beauty there is because you have a very large customer base of close to 5 million. And you are seeing that these customers have availed retail products in different percentages across different segments. We could slice and pick up customers of good profile, credit history with you and vintage with you, and offer them select products, helping them graduate through you and not necessarily through somebody else, because they have an association with you and you're meeting them weekly and they like how you're dealing with them, right? Because this customer segment, I've always seen, they have very high self-esteem than any other segment in my view, right? So they like to be dealt. Nobody's going to give them kind of doorstep service, the flexibility that comes with microfinance. So some of our retail products still continue to offer them weekly, bi-weekly repayment options, right? So we've carefully chosen a set of products which we think are very important for our customer as they move up, as well as for their livelihood. So some of the products that we've chosen include the graduation product, which is the unsecured business loan, and then beyond a certain ticket size, we are moving them to a secured business loan, right? So a few additional products that we've chosen for our customers. One is a home loan, because that's a very, very strong demand from our customer. And this segment, under 5 lakhs, not many of them are there or want to be there because economics may not work for them. Creating this whole structure, getting to them, having flexibility in repayment, all that may not work for them. But for us, the experiment has been so far so good. We've got around 350 crores of mortgage book now. And though we've launched the home loan only around a year back, around 50% of our disbursement today in mortgage is home. So home is coming out as a very strong demand from our segment. It can be home, it can be home improvement. So that's a segment that we will grow for sure. And over a period of time, we think we would be able to significantly retain good quality customers of us through this product for a longer tenure. So in that process, we will not be diluting any of our returns. You're not going to shoot up your OPEX because you have a very large field team. We have 15,000 field force, which is going to thousands of villages on a daily basis. So overall, I think we will revolve around this product. deepen them, experiment how to offer them. We may go wrong somewhere, we may correct some of them, but it would not be a costly experiment in that sense. For example, we did gold loan as a pilot. We quickly realized that at this point of time, it's not a ball game for us. We've rolled it back. So we did a 10 crore book and we've rolled it back to zero now. And we believe we can pick it up a little later point of time because it's very highly process driven. It's intensive with respect to investment on monitoring, storage, and you're not getting the kind of volume that you're getting because this needs a certain amount of infrastructure for doing this business. So each of this business has its nuances and challenges. So some products we may do, some products we may decide not to do. But at least for us, currently in the scale-up mode is unsecured business loan. We seem to have got it right. Even in the worst of the credit cycle, that book has held really good. 1,300 crores, 3 years vintage, par 30 is under 2.5%. When your microfinance par is very, very high. Mortgage has remained around 1.5% par. If I remove Karnataka, there again, we are under half of that problem. So that model's coming out well. So I believe that a lot of MFIs will also take this journey. But as long as it's calibrated, you're investing in the right technology, right resources and process, like you said, because each of this has its own nuances and challenges. But if you're gradual, if you're actually doing a lot of business with your cherry pick customers, it's a good ball game, right? For example, when we got into mortgage, we very clearly saw that under 5 lakhs had a lot of stress in mortgage, and greater than 5 lakhs, the quality was much better. So we took a call that under 5 lakhs, we will do only for our customer, right? Greater than 5 lakhs, we will do probably for open market. If it's open market, I'll not do under 5 lakhs. That was a call we took. And in this, though we don't have much of seasoning, it's 3 years, we should see another 3-4 years for us to see whether it is holding up. But at least the initial signs show that both of them are behaving extremely well. The only difference being that my association with that customer, and you are able to see them better for a longer time, and you're picking up a certain profile of customers. So if you're patient, if you're doing the right things, and if you kind of figure out the model well, it's a very beautiful segment, right? So I think it's good from retaining your customer as well as having a book which is balanced between secured and unsecured in the long term, is what I feel.
Sure, sir. Alok, sir, your views. Particularly, we have seen some players going aggressive in SBL segment and the small business loan segment, and there they've had their share of pain in that segment. So, any views that you have, some products that you would want to recommend, some you would say that better not to go into that segment?
Well, you cannot restrict any institution for business decisions because, as Ganesh said, that they did gold loan, they didn't find it worthwhile, rolled it back. So, as an industry association, and more particularly as an SRO, I would not be telling them don't do this, don't do that. That's their individual business decision. But right now, in the whole NBFC MFI sector, not talking about banks currently, other than one or two top 2-3 players, currently the focus is not there. The focus is not towards diversifying 40% or 30% of the book and taking advantage of it. The focus is on that building on the stability and getting the liquidity. The current next 4 months, 5 months will go in liquidity. Once that position starts improving and the portfolio continues to go down and becomes normal, I think next year onwards, it will be a good question to ask to diversification. Right now, it is a bit premature, at least in case of NBFC MFIs.
Sure. Now, that next question is more long term. So, there maybe you can answer that if you had to define what a future ready MFI looks like maybe in 2030, what would be key attributes? What are the 2 to 3 major structural shifts you foresee for the MFI sector in the next 5 years? And you can also comment like any regulation that you feel would come by. And Ganesh, particularly for you, like how are you positioning CREDAC to lead that change? For example, in terms of technology, people, products, and whatnot, like which is going to come in next 8 to 10 years. The world is going to change. So how the MFI sector is going to lead that change? So first to Alok sir and then maybe to Ganesh.
See, on the regulatory side, I think after this qualifying asset norm change, I don't think anything much is, anything is, not why I should say much, any demand from my side is left with Reserve Bank. So even when I go to the meetings with the governor, I don't have any substantive issues to talk about to him. because all the demands which you made have been done with. Liquidity is one thing which is not in RBI's control, no? That is bank's decision. So you can't tell RBI that why banks are not opening their tap. Only thing with, there are, if you say about future ready, na, so I will not get into business strategy, but on the foundational blocks which the institutions have to work upon. There are 2-3 key issues which I talked to. One is that we have to settle this either way a KYC issue. Because Aadhaar not being there, if you are using voter ID not foolproof, some people trying to do CKYC, then we try to do PAN, and government is also conscious of it, RBI is also conscious of it, parlays are happening, we have to crack this. So it's a KYC which is 100% foolproof, because otherwise these 3-4% cases of over leverage happen because of that. That we have to tackle, number one. Number two, on the institutional side, I would say that like Credit Access has shown the way, other institutions also slowly have to diversify their sources of funding, reduce their cost. If suppose you are at 13%, you should almost come down to 10%, though it depends on general economic conditions. OPEX also, it is increasingly being viable that despite deregulation of interest rates, while on paper it is deregulation, but in general perception, in regulators' perception, there is somewhere a ceiling. Though we say that there is no ceiling, but there is a visible ceiling available. So you also have to, people have to work on the OPEX as much as possible, because whether it is through technology, increasing productivity, that has to be a foundation. So because it remains very difficult that, to me, it looks like next 5 years you won't be able to run this business with 8.59% operating expenses ratio. You have to bring it down. Third foundational aspect on operational aspect, why this OPEX is going on is related to it, that somewhere or the other we have to bring down the staff attrition. At 50-54% staff attrition, where every 2 years there is a new organization at the field level, you won't be able to sustain. And that is why the training suffers with that. And the other last thing which they have to do, once this situation, which is already showing signs of stabilization, they have to see that now that the flexibility is there, they have a balanced book, so that in times of crisis, it doesn't become like this. The other portfolio is able to cross-subsidize. These are the 4-5 things which I think sector has to do next year.
Thank you. I think Alokji more or less covered everything, but a few more things that come to my mind very clearly is one, there has to be a lot of agility going forward, right? So you can't behave the same way every year. Things are changing. So you must have the right technology to support it. And like he said, you should have a very good people strategy, right? Microfinance per se is strongly dependent on only 2 things, process and people, right? And there has to be a lot of investment in people, how you train, how you retain, right? So that's going to be a consistent focus area for us also. And liability, like he said, very clearly, the more broader you become, we are seeing that it is helping us kind of, run in both in good and bad times at certain paces. So diversification definitely is something that you need to be very mindful of, and with growth, you have to package this together. You have to tie up how you're going to raise resources, because one side of the balance sheet is given. There is enough demand, you can grow and all that, but you need to constantly need liability, right? So that's a very key focus area, I think, for any growing institution, especially this sector, because in bad times you see liquidity getting squeezed, and then all your other numbers goes for a toss. Your OPEX goes for a toss. If you're not disbursing, your book is not growing. So all other numbers kind of miss its balance. So I think that will be a very critical thing. And like I said earlier, digitization is also something that we need to really work on. There is something that is changing in customers, right? We know that attendance is dropping, but we still see that our collections on a daily basis is still coming through a group model. We are not running door to door. To a certain extent, yes, majority is still coming to the group model, but the attendance is dropping. And you are seeing that employability is increasing. So what's going to happen if more digitization happen? Today, from 0%, we're doing 16% digital collection. If it's going to go 40, 50, then the main purpose of the meeting used to be repayment, etc. How is that going to pan out? So I think there is a lot of research and investment and experiments that as a company we are doing. Even as an industry, we need to be mindful of changing aspects. Like I said, be agile. We'll have to experiment on new things and kind of be ready. Whichever direction the industry would go, then the company would be prepared to kind of handle it quite well, is what comes to my mind. Thank you.
Well said, both of you. Now we'll open up the floor for Q&A from the audience. So if anyone has a question, please raise your hand. Yes, someone can give the mic to Sachin.
Hello. Yeah, thank you. This is for Credit Access Grameen. You did speak about calibrating the growth as we go ahead. Say, if you take the next 5 years, and if you have to put that in sync with your ROEs, with a return on equity, say next 5 years average ROE, because we've seen some cyclicality. So if you take the average next 5-year ROE, so will it be fair to say that with everything that's been happening and now that you're also thinking about calibrating the growth will be significantly below, when I say significantly, say 300, 400 bips lower than the ROE? And as a, and because of that, can the dividend payout be much higher? I mean, how do you see this, the architecture over the next 5 years in terms of the business economics?
See, I think two factors to this. One, industry level, there could be certain moderation in growth because of guardrails, right? But then to a certain extent, that can be kind of met out if you're spreading out wider, right? So because we still see there is enough penetration that needs to happen, and there is enough scope for growing your book in geographies that you are, right? That is one side of it. Second side is, as you grow bigger, your growth will anyway taper, right? When we were smaller, we were growing at a very high rate. We were at 30, 40% sometime. We were at 30% sometime. Now we're talking about 20, 25%. But what we are seeing that now that we've become a very large base, the growth in microfinance will kind of taper, will probably be in teens. But as a company, we should still be able to manage growth in the north of 20% in a normal year. And that will comprise of both microfinance and retail. And since the products that we've chosen are not diluting the returns in any nature except for home loan, I think we should be able to deliver the kind of returns that we envisage, probably in a good year, maybe around 4.5%, 5%. In a bad year, around 2%. On an average, we are thinking, we're right now at around 3.5% cross-cycle ROA. We should move closer to 4 as we build our retail finance book. That will give us a little bit of shock absorbent in case microfinance goes through cycles. So that's what we plan to do. And I don't see either growth or returns as something that we would compromise.
Yeah, got it. So what you're saying is broadly it will be in sync, both of them.
Yes.
Oh, got it. Thank you.
Thank you, Sachin. Any other participant has a question? I have one question around the AI. Since morning we have had so many people coming on the semiconductor side, and AI obviously is taking over. If I peep into next 10 years, I'm sure a lot of fintechs also would want to get into this segment with the tech, the algorithms, and so on. And so, how do you see the microfinance sector evolving, particularly with these fintechs coming into with all the technology, the data, and so on? Do you see that happening in next 8 or 10 years? The sector as such will see a complete change in terms of who are the participants. Right now, you have banks, you have NBFCs, you have SFBs, and so on. So, yeah, over to you, sir. What do you think on this front?
Okay. So, see, my thought, historically, many times, we've seen that a pure tech-based, database approach may not work in this segment. It has to be a combination of people and data. We also have to understand there are not too many data points available for the segment itself, right? So as things improve, as digitization picks up, as people transact more in data, probably at some point of time, there will be enough data to ascertain. Today, if you see, other than KYC, and your look and feel of the customer, their economic activity, there is not much of data, right? So you can get some amount of data from the credit bureau, but we are talking about financial inclusion. We're talking about adding people who have no credit history to come into us. people who have no documentation to prove what is their income, right? So this works with a combination of both data and tech. For customers who have evolved credit history, maybe you can do a little more. But as data points increase, that is something that can happen. We're also working to see if some of these new technologies can even help us capture data points, right? So for example, the quality of the customer's house, does it relate to anything? What could be their income? What is the economic activity we're seeing? What is the scale of it? Can technology help us to a certain amount of income? So these are very early stage journeys that many of us would take up. But I think for lending at all points of time, it has to be a combination of both tech and data, unless it's beyond a certain level or certain profile of customers. It's good to have data and people together.
So is it fair to say that because it's a high touch model, because a lot of people involvement is there, AI certainly might disrupt many other sectors, particularly the microfinance sectors will be relatively less disrupted in at least the next 2 to 3 years, maybe decade. We don't know how it's going to.
I'm saying it will enhance, right? It will enhance. I'm saying AI today, we are experimenting to see whether instead of relying on your field level officer for income assessment, can I do better, right? Can I use some modeling to see what is this person I'm dealing with, right? So some of this could evolve, but I'm saying as such, we are not in a stage where it can kind of displace or replace microfinance.
Great, sir. I think with that, we will, I think, end the session from our side. Yeah, over to you, Deepa.
Thank you so much, sir. That was quite knowledgeable, that how the whole segment will shape up in the next 5 to 10 years. I would now request our MD and founder, Mr. Karwa, to come over and facilitate our distinguished guests. Thank you so much, sir, for your participation. Have a great day ahead. We'll start.